People think the biggest threat to their investments is a market crash. It isn't. The real danger is what happens inside your own mind when prices start falling. Imagine opening your investment app one morning and seeing thousands of dollars, or Naira, gone overnight. Your heart races. Every headline screams that things will get worse. In that moment, selling feels like the safest decision you could make. Yet history shows that's exactly when many investors make their most expensive mistake. If you've ever wondered why investors panic at the worst time, you're not alone. It's not because they're unintelligent, it's because they're human. Our brains evolved to survive immediate threats, not to navigate the emotional roller coaster of the stock market. And unless you understand that psychology, your emotions can quietly become your worst financial advisor. Behavioral finance has revealed something fascinating. People experience the pain of losing money much more intensely than the joy of gaining the same amount. This is called loss aversion. Imagine finding 100,000 Naira on the street. It would make your day, but losing 100,000 Naira from your savings would probably bother you for weeks. That imbalance drives countless investors to sell during market crashes, locking in losses that might have recovered with time. Think back to major market downturns. Whether it was the global financial crisis of 2008 or the sharp decline during the COVID-19 pandemic, fear dominated the headlines. Many people sold their investments believing the worst was still ahead, yet markets eventually recovered, rewarding those who stayed patient. The pattern repeats because human emotions rarely change, even when the circumstances do. Legendary investor Warren Buffett famously advises people to be fearful when others are greedy and greedy when others are fearful. That sounds simple until your portfolio is dropping every day. Knowing the right thing and doing the right thing are often two very different challenges. So how do disciplined investors avoid emotional investing? They begin with a plan before emotions take over. They invest money they won't need immediately, diversify their portfolios, ignore daily market noise, and remember that temporary declines are a normal part of long-term investing. Most importantly, they understand that volatility is not the same as permanent loss. Here's something worth remembering the next time fear starts whispering in your ear. The market doesn't transfer wealth from the unlucky to the lucky. It transfers wealth from the impatient to the patient. Every market crash eventually becomes a chapter in history, but the decisions you make during those moments can shape your financial future for decades. The greatest investment you'll ever make isn't just in the market, it's in mastering your own mind.